topics and opinions expressed in the following show are solely those of the hosts and their guests and not those of W4CY Radio, its employees, or affiliates. We make no recommendations or endorsements for radio show programs, services, or products mentioned on air or on our web. No liability, explicit or implied, shall be extended to W4CY Radio or its employees or affiliates. Any questions or comments should be directed to those show hosts. Thank you for choosing W4CY Radio.
Barry G. Fowler, EA, brings you Tax Talk for You right here on W4CY Radio and Talk4 TV. As an enrolled agent and a national leader in tax resolution, as well as trucker, bookkeeping, and tax planning with over 30 years of experience, Barry will break down taxes, bookkeeping, tax planning, and tax relief for individuals and businesses just like you. So let's have some Tax Talk for You with your host, Barry G. Fowler.
Hey, good morning and welcome to Tax Talk for You, man. This is a Monday of talking about the one big, beautiful bill. You know, it's amazing to me that we pass legislation, and instead of breaking things down and doing them in small bills, they do this one humongous, big, beautiful bill, as Trump calls it, and as it's called in law. Now, there are a lot of good things that happen in this bill, and I understand that some things are going to take a lot of pages, but this bill is, I believe, 870 pages long. It's right around there. I've looked at it, studied this bill, and we're kind of dissecting just the tax part of this bill that President Trump signed into law on July 4th. Now, one part of this bill, which is great, it permanently extended key tax cuts and Jobs Act provisions, and then introduced new tax provisions as well. So what we've been operating on for the last, roughly 8 years, we're going to continue operating underneath that original tax cuts and job acts, plus the new provisions that are put in. And we're going to discuss a lot of those new provisions here in the show. The new legislation introduces tax relief for middle-class families and workers, and also aim to simplify compliance, reduce taxable income for certain earners, and broaden access to tax benefits. This all built around the 2017 Tax Cuts and Jobs Act. Now, in this bill, you're going to see the extension. I'm like getting phone calls in the middle of talking. I thought we turned everything off, but my watch keeps going off now. So I got to figure out how to silence that as well. It's going to enhance the standard deduction, introduce some notable updates, including deduction for overtime, expanded child care credits, deduction for seniors. It also launches Trump accounts for young savers. So we're going to kind of go through each one of these things all throughout this program. And this is all going to be geared around the individual side. Now, we spent many, many hours going through this whole bill and pulling out sections of this bill to be able to talk about, to help you further understand what this does for you as an individual taxpayer. Now, next week, we're going to address a lot of the stuff in this bill that involves businesses. And so you want to make sure you tune in to Tax Talk for You next week at 10 a.m. Eastern Time to be able to get what this bill does for you and your business. But this bill, on the individual side, does an extension of reduced income tax rates. So the provision permanently extends the individual income tax rates introduced by the TCJA that were previously set to expire at the end of this year. The amendment to the bill eliminates the sunset clause ensures that there are reduced marginal rates of the 10, 12, 22, 24, 32, 35, and 37 remain in place. This provision is intended to lock in those lower marginal tax rates, prevent automatic rate hikes that were going to happen in 2026, provide continued tax relief to individuals and families, and control the way bracket thresholds grow with inflation for better targeting of the rate brackets. So that being said, we don't have to be scared that all of a sudden in 2026, all of our rates are going to jump up and we're going to go back to some real old code. So that's the good news in this bill. It's one thing that us as tax preparers were really hoping for was the extension of the tax law. With the election of President Trump and the Republicans being in Congress and dominating both houses, we figured this should go through, and we're glad that it did, because it really ensures that we keep these rates going out to the future. There are two changes to the standard deduction rules. Now, the first, the law permanently preserves the current tax code, enhanced the standard deduction amounts. Under the prior law, the increased deduction initially established for years 18 through 25, those were set to revert back to the 2018 levels beginning in 26. The law also increases the base standard deduction amounts beginning in this year. So we were already getting a jump for inflation, but we're also getting the jump and increase with this bill. So the new base deduction is $31,500. So it is an increase over the inflation adjusted amount of $30,000. So a married filing joint, it's now $31,500 for 2025. So it jumped up $1,500. So the new amount for single is half of that. That's $15,750, exceeding the prior inflation adjusted amount for this year of $15,000. So there's an extra $750 if you're single, extra $1,500 if you're married filing jointly. Now, this is a standard deduction. And, we have seen, unless you've taken out a new mortgage in the last 4 years, many people didn't qualify to itemize. Many people just took the standard deduction. So that's really a nice provision in this tax law. So you see a bigger standard deduction for this year, and then it'll start being inflation adjusted every year thereafter. So it's going to give a direct savings to many, many U.S. households starting this year. Also, we have some termination of personal exemptions. Those were temporarily suspended underneath the Tax Jobs Credit Act. This makes it permanent, so we won't have the individual exemptions coming back. You just got the larger standard deduction. Now, Trump kind of promised no tax on Social Security. Well, Congress gets involved. Congress decides they're going to do it a different way. Now it nets down to it. It basically gives no tax on Social Security, but it gives the seniors beginning this year through 2028, individuals age 65 or older, by the end of the year, you get to claim new deduction of $6,000. On a joint return, each spouse may qualify for that $6,000, giving you a total of $12,000 in total deductions, as long as you're both age 65. Now, they threw in some phase outs. So they say this bill is only benefiting the rich. These phase outs are because people make too much money, according to Congress. Not in my opinion, Congress's opinion, president's opinion, maybe. But I really think this is purely Congress trying to appease certain people and saying, hey, we're going to continue to tax those that we consider to be rich. Now, believe it or not, this bill has a 6% phase out on modified adjusted gross income exceeding $75,000 for single filers. All right, raise your hand if you consider $75,000 as a single person rich and wealthy. Only the Congress raised their hand. $150,000 for joint filers. How many of you making that kind of money consider yourself to be totally rich to start having these phase outs? Only Congress is raising their hands now. Now, a couple other things. Seniors must possess a valid Social Security number to claim the deduction. I haven't seen anybody file without a valid Social Security number, maybe an ITIN number, but you got to have a valid Social Security number. An omission or invalid Social Security is treated as a mathematical or clerical error, authorizing the IRS to adjust the return accordingly. They get to adjust your return. Married individuals must file a joint return to be eligible. Married filing separate is not permitted for this deduction. So if you're married, you got to file a joint return. 65 or older, you both can get it. If you file married filing separate, it is not going to be there. Wow, a lot of changes already. We're talking quick through this bill. We only get an hour to do this. We're going to take a quick break, and when we come back, we're going to talk about extensions with changes to the child tax credit. We'll be right back after this.
We have only scratched the surface of today's show. Please stand by as Barry G. Fowler will be right back with Tax Talk for You. If you owe the IRS or are going through an IRS audit, don't go at it alone. Call Taxation Solutions Tax Relief at 888-930-1016. We are your solution for IRS debts, audits, back taxes, garnishments, liens, and levies. Whether you're an individual or business, you need a solution and a strong, aggressive tax resolution. Don't let the IRS walk all over you. Stop the IRS now. Call 888-930-1016 or go to taxationsolutions.net now for a free, no obligation consultation. Let's get back to Tax Talk for You with more Tax Talk. Once again, here's your host, Barry G. Fowler.
All right, you got children. What's changed with the child tax credits? So there's been several changes to the child tax credits, and it takes effect starting this year. So what we were fixing to do is at the end of this year, child tax credit was going to drop back down to the original amount of $1,000. But this bill, effective 2025, the maximum child tax credit per qualifying child increases from the $2,000 to $2,200. Beginning in 2026, this amount is subject to annual inflation adjustments. Now, the refundable portion of that credit remains capped at $1,400 per child, but that is also going to be indexed for inflation beginning this year. So we might see some adjustments to that as well. Now, what do they mean about, hey, you get a $2,200 tax credit, but you only get $1,400 of it refundable? So if you are paying taxes and you have tax showing on your tax return, not owing, but total tax. Deduct the $2,200 from that total tax, and it leaves you what's left to be paid. Now, if $2,200 is used to get you down to zero tax, then you can still get $1,400 refundable to you, possibly depending on how much of that credit was used. So if you didn't use all $2,200, let's say maybe you only had $1,000 of total tax, they'll use $1,000 of that 22 and refund you the $1,200 difference, plus any of your federal withholdings that you've paid in. So, you got to look at whether you qualify or not. Qualifying here, again, you must have a valid Social Security number, must be a U.S. citizen, or certain legal residents could qualify as well. So keep those things in mind as you're going through and doing this. Hey, one of the nice parts about this bill, and we're going to kind of skip through a few of the sections out here because there are other enhancements out here, but this is one of the places that people really wanted to know about. You heard it. No tax on tips. That's right. Trump said it. No tax on tips. Congress got involved. Guess what? Limitations. Of course there are. So Section 224 allows individuals to deduct certain cash tips from their taxable income. The deduction is available for tax years beginning after December 31, 2024. So starting in 25 through 28. This applies to individuals who receive cash tips in an occupation that customarily and regularly receive tips. Now, who that is and the professions that are included is going to be determined by the IRS. Will be published sometime this year, hopefully. Both employees and self-employed individuals may be eligible, but the deduction is limited for self-employed taxpayers if business expenses exceed income. Now, married taxpayers are going to have to file jointly to claim the deduction. So now, the one thing I want to say is the tips still going to be reported on your W-2, are still going to be taxed for Social Security and Medicare. They're just not going to be taxed for federal income tax. Now, that deduction is limited, and it's capped at $25,000 per year and phases out if your modified adjusted gross income exceeds $150,000 for an individual or $300,000 for joint filers. Now, it's amazing. Seniors, you get capped at a much lower level than the people that are getting tips and are being capped at a much higher level. Why is that? So what they were figuring is that if you're retired and you're getting above that $75,000 as an individual in Social Security and having taxes, means you're probably rich and pulling more money out of retirement accounts than other people do. So they were trying to give you just the benefit of no tax on Social Security portion of it. Now, a lot of people have been asking me, what is defined as a tip? Because you see in the first section, in the first time we read through the law, it said cash tips, meaning, hey, do I actually got to lay down, the greenbacks on the table for my waitress or waiter to tip them, or can I put it in my credit cards? So they do later in this bill state tax tips, tips that are not going to be taxed, and you're going to include cash and card-based payments and amounts distributed through tip sharing arrangements. So the tip, to be perfectly honest here, it's got to be made voluntarily by the customer and not subject to negotiation or determined by the restaurant or the place of business. Should be determined solely at the customer's discretion. However, tips received in a specified service, trade, or business as defined under Section 199 are excluded unless the recipient is an employee or of an employer not classified as a specified service, trade, or business. I sure hope they're going to interpret some wonderful rules. I know what this means, but the normal American taxpayer doesn't. Now, does this rule mean that, let's say you are the waiter or waitress and you have a party of 10 or more that you're serving, and there's an automatic tip calculated into the bill? Does that mean you don't get to exclude those tips? We're still having to wait to see how the IRS interprets this fun stuff that's in this bill. Now, I don't think they were meaning to put that in there. I think they were meaning that if you were in a specified service and, maybe you were required to give this kind of tip as part of the service contract, those would be excluded. I just don't know how they're going to make this work. We were concerned at the get-go of this when they were announcing no tax on tips, was it going to include Social Security and Medicare? Because you as a tipped service, if you're not reporting it and paying tax under Social Security and Medicare, then you're not going to get credit for those tips towards Social Security. And Social Security is based off of your past earnings. So would that mean that there'd be a huge reduction in what you would be receiving later in life because we weren't including these tips over there? So, those are the kind of things we were kind of concerned about, but it looks like they're accomplishing that and still having it put on the W-2. The employer is still paying their portion on tax tips and reported you're paying your portion on those tips as well. So, there's still going to be tips going in, tax on tips going into Social Security and Medicare, just no federal income tax on them, subject up to a limitation of $25,000. So just remember, the limit is up to $25,000 in qualified tips. That's where the deduction limit is at. It has an income phase out at $150,000 for single, $300,000 joint. Tips must be voluntary, and it has to be from a tip eligible occupation. Time frame on this thing, again, is 2025 through 2028. Employers must track and report tips separately. So there's going to be another box on your W-2 form out there. Now, the additional provision to this tax on tips, within 90 days of this bill's enactment, so 90 days from July 4th, the IRS is going to publish a list of qualifying occupations. So starting also in 2026, the IRS withholding tables will be updated to reflect the new deduction. So there's going to be a whole new employee deduction for those that are taxed on tips. And the bill expands the Social Security tip credit to cover beauty services such as hair, nail, spa, and aesthetic services. Whew. These are fun things in these bills. I can't wait to see some of the other interpretations by the IRS. Hey, we're going to take a short break here, and then we're going to talk about no tax on overtime. No tax on overtime. We'll be right back at this.
We have only scratched the surface of today's show. Please stand by as Barry G. Fowler will be right back with Tax Talk for You. As an owner-operator, you already spend too much time away from your family. Trucker Tax Tools handles all your bookkeeping and taxes no matter what level trucker you are. Life on the road can be taxing, but that doesn't mean that your wallet or time with your family should suffer. Trucker Tax Tools makes your life run smoothly. Go to truckertaxtools.com for a free guide that will give you the tools to never worry about your taxes again. Call Trucker Tax Tools 877-966-2477 or go to truckertaxtools.com now and let the experts keep you trucking. Let's get back to Tax Talk for You with more Tax Talk. Once again, here's your host, Barry G. Fowler.
Hey, welcome back. Hey, speaking of trucking, if you're looking for somebody to help you with your bookkeeping and your taxes and your trucker, Trucker Tax Tools is the place to go. Go to truckertaxtools.com. Give them a call, 877-996-2677. You know, talking about taxes and, you know, some of the things that we're looking forward to see the interpretation by Congress and how they're going to implement the strategies and the plans that Trump is setting forth to lower your taxes. And one of the areas he promised was no tax on tips. You know, no tax on tips sounds great. And we're kind of waiting on the interpretation out here because, you know, we've read the bill and gone through the whole bill and we come up with what we think is no tax on tips. And then working with some of our associations out there, they come up with some other ideas what no tax on overtime is. And I meant overtime, not tips. The tips portion has been laid out, you know, really good out there, although we got to wait on the industries on here, but no tax on overtime. So here's what's in the bill. Taxpayers are going to be able to deduct the amount of overtime compensation received during the taxable year, provided the compensation is reported on either a W-2 or an information return per section 6041D4 of the big, beautiful bill. Only overtime that qualifies under section 7 of the Fair Labor Standards Act of 1938 is eligible. Wow, we got to go all the way back to the Fair Labor Standards Act of 1938 to determine what is eligible. So that is pay for hours worked in excess of the standard work week, calculated at a rate above the individual's hourly rate. Whew. So, qualified overtime. Now, there are two primary limitations. There's going to be a dollar amount cap and an income-based phase out. First, the maximum deduction is $12,500 for single filers, $25,000 for married filing joint. Second, the deduction is gradually reduced for higher income taxpayers. So for every $1,000 that you, a taxpayer, exceeds modified adjusted gross income of $150,000 for single, $300,000 for married filing joint, the deduction is reduced by $100. So if you're earning over $150,000 or over $300,000 married filing joint, you're going to see a reduction of $100 for every $1,000 you earn over that as a modified adjusted gross income. Again, this is taxable years only 2025 through 2028. And again, it's only permitted when a taxpayer includes the recipient's Social Security number on the return. So there's some good things out there. The deduction, again, is only available if you are married and married filing jointly. So now, here's where the confusion comes in. There is one calculation where it takes your whole overtime. So if your hourly rate was $20 an hour and your overtime pay is $30, 30 times however many hours of overtime you have, you're going to get the benefit of the full amount up to the $25,000 as long as you're below the thresholds. The other side of this is people were coming in and interpreting this to be that just the overtime portion of the rate would be where you would save it. So you worked, your rate is 20, your overtime rate is 30. The actual overtime rate is considered to be 10 times however many hours you work. And then you would get the savings based on that. So if you work 250 hours of overtime during a year, you would only save $2,500. So that's where people are going to get a little bit confused. We're waiting to see the interpretation of this. And because it's retroactive back to January 1, 2025, there's going to have to be some adjustments in future W-2 forms this year, and also going to have to be some adjustments to withholding tables, possibly through the rest of the year. Now, they say they're going to start adjusting the withholding tables next year, which means you're probably going to over withhold this year, and you'll see a larger refund due to the changes here. Now, if you happen to be to where your threshold modified adjusted gross income is going to be above the 150 or 300,000 starting in 2026, when they have the adjusted withholding tables, you might have to adjust your withholding to make sure you cover enough money, especially if you're going to be subject to phase out. So let's say you're married and your spouse has a very good job and, maybe making somewhere in the six figures, and you're working at a job that you get tipped. You combine that and your modified adjusted gross income goes above that 300,000, and you've been withholding at a lower level. It means you probably end up owing money when you come back to filing your tax return. So you want to keep those things in mind. This is not going to be something that you're going to have to itemize. The deduction is supposed to be added to the standard deduction for non-itemizers. IRS is authorized to regulate and prevent abuse. Hey, fun. Such as recategorizing wages as overtime. I can see that happening. I can see people doing that. Your W-2s must report overtime separately. In the law, it's also kind of said 1099s as well, but you're typically contract, so I don't know how they're going to report overtime on a 1099, but yet that's to be seen. And then you remember this deduction is going to go away after 2028. I really hate when they put things like that into this law. Why couldn't they just make it permanent so that people could understand it a little bit better going through this? These tax laws and what they've put in place, and some of them being temporary, we have to be happy that the original Trump tax code has been made permanent. Now, how long does permanent last? Well, at some point, somebody is going to take over both the House and the Senate, and they're going to find a way, just like Trump did, to pass a new tax code, something that will change again. But we can at least say, hey, this is going to be definitive for us over the next 3 years with these things in place. And after 2028, we'll see what happens. Maybe they'll come in and make these permanent for the senior deduction for the overtime and the no tax on tips as well. Maybe they'll find a way to make those permanent out there. It's kind of like, they do need to find a way to reduce the debt service. Part of that may be reducing the interest rates that the federal government pays, reducing interest that we pay, so that we can get back to, maybe buying real estate at a reasonable rate, at a reasonable interest rate, and being able to qualify for a home and everything could all be important out there. Or even being able to buy a new car. Now, speaking of new cars, we're going to take a quick break and we're going to talk about deductible car loan interest, which is new in this tax code. We'll be right back.
We have only scratched the surface of today's show. Please stand by as Barry G. Fowler will be right back with Tax Talk for You. As an owner-operator, you already spend too much time away from your family. Stop spending time doing paperwork. Go to truckertaxtools.com, a solution built specifically for truckers. Truckertaxtools.com makes your life run smoothly. Let's get back to Tax Talk for You with more Tax Talk. Once again, here's your host, Barry G. Fowler.
Hey, welcome back. Hey, maybe you're in the market for a new car. Hey, Congress has made deductible car loan interest for tax years 2025 through 2028. Interest paid on a loan to purchase a qualifying passenger vehicle for personal use may be deducted under a temporary provision. Now, to qualify, the loan must be incurred after December 31, 2024, and secured by a first lien on the vehicle. The interest is only deductible if the taxpayer includes the vehicle's identification number on their return. Refinancing of such loans is also eligible for the deduction, but only to the extent the refinanced amount does not exceed the original loan principal. Now, we're subject to several exclusions. Interest on loans for fleet sales, commercial use, leased vehicles, salvage title vehicles, vehicles intended for scrap or parts is not deductible. Additionally, loans from related parties are excluded from eligibility. Deduction is capped at $10,000 of interest per taxable year. It's also phased out for higher income taxpayers. Now, if your modified adjusted gross income exceeds $100,000 or $200,000 for joint, so $100,000 single, $200,000 joint. Amazing how these different levels here, couldn't they have at least kept everything simple where the phase outs come in? If you do hit the phase out amount, it's going to be reduced by $200 for every 1,000 or part thereof. Don't know how they're going to accomplish this. If you remember back, they one time talked about just having a postcard to file. That postcard has gotten expanded, is now a full page postcard and has schedules and subschedules. So, again, we're making the tax code a little bit more complicated. It was going to be simplified, and now it's become even more complicated on the return. So, we got to watch how this is going to be put in. The only way I can think is that they're going to have another schedule, and then it'll go to Schedule 1 and then come over to the main tax return. Now, we've got all the confusion out there about this. How have they defined a qualified vehicle? So the way this bill is defining the qualified vehicle must be intended for the taxpayer's original use and primarily manufactured for use on public roads. Eligible vehicles includes cars, minivans, vans, SUVs, pickup trucks, motorcycles, as long as they have at least two wheels and a gross weight rating under 14,000 pounds. Vehicle must also be classified as a motor vehicle under the Clean Air Act and assembled in the United States. Not completely manufactured here, but has to be assembled here in the United States. This deduction is available to both people that itemize and those that do not itemize. So if you don't itemize, you're going to be able to claim the deduction as an above the line adjustment to income. Now, if you're in business, one thing to be very clear, this does not cover you in the business. The interest you still incur on business use vehicles still remains deductible for the percentage of business use of that vehicle on the business return associated with the use of that vehicle. So if you buy a car or a truck or some vehicle that qualifies under what's a qualified vehicle, you're going to be able to deduct the interest and depreciate that vehicle still on your business portion of the return. So that doesn't change for business purposes. This is only a change for individuals that are buying a vehicle for personal use. So does this benefit you if you were going out to refinance your current vehicle out there? Yes, no, maybe. Depends on where your modified adjusted gross income is. Depends on what the change of the interest rate is as well. If you bought a vehicle several years ago and the interest rate was lower on your vehicle, you may not want to refinance because it may not benefit you enough. However, maybe you bought the vehicle within the last year, you bought it sometime in 2024, and you want to go in and refinance it. What we see in this book in the bill is that you may be able to go in and refinance. You got to look at your modified adjusted gross income and see if you're going to be subject to that phase out. So maybe you can reduce your interest rate by refinancing, or even if it adjusts your interest rate by a little bit, maybe you'll be able to take $10,000 off the top. Now, taking that $10,000 off the top and you're only in a 10% tax bracket saves you $1,000. But you may be paying more in interest because your interest rate may be going up. You may even pay less. So you got to kind of run the numbers, have your tax preparer look at this with you and make the decision. Now, with this, you need to really analyze how all these things impact you on your tax return. So I hope you have a good tax preparer who can go through this stuff with you. Changes to charitable contributions. So this bill had an amendment that applies a 0.5% floor against the sum of charitable contributions that a taxpayer makes. Only the amount of charitable contributions above this floor can be deducted. So Section 170B1 states that an individual taxpayer may only deduct charitable contributions to the extent that the aggregate amount of your contributions exceeds 0.5% of their contribution base, generally 0.5% of your adjusted gross income. So that means you're not going to receive a tax benefit for the first 0.5% of your contribution base donated to charity. The only amounts contributed beyond that threshold are eligible for deduction, subject to other existing percentage limitations for charitable deductions. So, if you are rich, this is going to impact you more than if you have less income, because you've got to get over that floor of the 0.5%. Section 170B-1.G was updated to clarify the 60% adjusted gross income for cash contributions to public charities. The maximum deduction for cash contributions remain capped at 60% for the taxpayer's contribution base. Under subparagraphs A and G, now coordinated explicitly to avoid exceeding combined deduction limits, ensuring consistency in applying percentage ceilings across different categories. And many taxpayers aren't going to worry about this, aren't going to be impacted by this. You're going to see this impact mostly on the wealthy that are out there, again, trying to impact on the top 1%. Now, if you don't itemize, this permanent charitable contribution deduction is available to you, okay? So it reinstated and increased the above-the-line deduction limit for charitable contributions made by non-itemizing individuals. If you remember, we had that $600 deduction at one time. Now we're going to have a maximum deduction for single filers, $1,000 above the line, even if you're not itemizing. Married filing jointly, it's $2,000. And it's going to be applicable for years after 2025. So this is going to start 2026. So just remember that if you're an individual taxpayer, you're not going to be able to deduct the first 0.5% of your contribution base. And so a good example here, taxpayer with $100,000 of adjusted gross income, you have to contribute $500 before any charitable deduction is allowed. Any disallowed contributions due to the new floor can be carried forward if total contributions exceed other applicable deduction limits, preserving the tax benefit in future years. Taxpayers with smaller charitable giving patterns or those with income volatility could see deductions reduced or eliminated in low income years. Planning to bundle donations in alternate years increases contribution levels and may help increase your tax benefits. So, there's strategies you can use out here depending on your income levels to, group your contributions. Hey, remember, if you're a senior and you have required minimum distributions you have to take, there is a way to make your required minimum distributions directly to a charity to avoid taxability of them. There's a lot of things in this tax law. We've only scratched the surface. Next week, what we want to do is come back. We want to talk about QBI, qualified business deductions. We want to talk about Trump's new accounts, the Trump accounts. We want to talk about lowering expanding the SALT limitations, state and local tax, 529 plans. All these things have changed. So we will try to fit some of these things in next week when we're talking about this one big, beautiful bill, business deductions and how it impacts businesses. But we'll continue to talk more about the different things that are in this bill that affects you and I on the individual level for taxpayers. Hey, again, remember, we're just scratching the surface of what this bill is going to do for you as the individual taxpayer. So there's a lot of good things in this bill. You just got to stay tuned. Hey, make sure you connect with us on Facebook. Find us at taxtalk4u.com. Go over there and like us. Share it with your friends and family. Get this information out to everybody. This one big, beautiful bill helps most Americans across the board. It is something that can provide you a great way of saving money. How does this impact you? Come back next week at Tax Talk for You. Again, like us on Facebook, share it on Facebook. Get the information out there, but tune in every Monday here at 10 a.m. Eastern Time on Tax Talk for You. You can also check out taxationsolutions.net, Taxation Solutions Tax Relief on Facebook, truckertaxtools.com, Trucker Tax Tools on Facebook. Connect with us. Learn more about what we can help you and how to help yourself save money on your taxes right here on Tax Talk for You, taxtalk4you.com on W4CY Radio. Thank you. Have a God bless, glorious, and awesome week. And we'll be back next week.
Are you an individual or business that wants to understand taxes and how they affect you? Are you looking for specific tax advice for self-employed, business owners, and truckers? Are you behind on taxes and your bookkeeping? Are you dealing with the IRS and ready to have some relief? Then you need Tax Talk for You, hosted by tax and trucker expert Barry G. Fowler, EA. Tune in 10 a.m. Eastern Time every Monday right here on W4CY Radio and Talk4 TV. Don't forget to check this and past episodes at taxtalk4you.com. See you next week at W4CY.com.